All right, so I want to welcome everybody to tonight's boot camp. My name is Rotimi Olawale, and I'm your trainer for tonight. And today we're going to be looking at, yes, I can see that. Oh, they are Wara. We are ready, and I'm also ready for you. I tell you what, we're going to have a nice time tonight, learning new strategies which we can use to trade the forex market by looking at the moving average. So the title of the topic is Riding the Waves, Amplify Your Profit with Moving Averages. In fact, we also coined it in another way. We called it Advanced Moving Average Strategies. So let's get started. So what are moving averages? So we said that moving averages are one of the most commonly used technical indicators. A moving average is simply a way to smooth out price fluctuation to help you distinguish between typical market noise and the actual direction. You know, in trading, there is always a lot of noise, a lot of noise. You know, sometimes there could be a lot of noise on lower time frame, and sometimes even there are movements in the market that could be characterized as noise. And that is one of the things this moving average can help us to filter out or to smooth out. So by moving average will mean that you are taking the average price, the average closing price of a currency pair for the last X number of periods, and on a chart, it's going to look like this. This is what the moving average looks like. Now, when you attach a moving average on your chart, you will see that the price, is always either above or below the moving average. So you can see the blue line here, and this indicates the moving average. So moving average of closing prices of the last 10 periods, that is what this diagram here is showing. So as I said, we said that moving averages smooth out price action. It helps us to filter price to get, something much more smooth for us to trade. So there are different types of moving averages, and each of them has its own level of smoothness. Generally, the smoother the moving average, the slower it is to react to the price movement. The choppier the moving average, the quicker it is to react to the price movement. And to make a moving average smoother, you should get the average closing prices over a longer period of time. So we're saying in essence that sometimes to get the best of these moving averages, it's better to look at them, on a longer period of time, sometimes maybe on a higher time frame, kind of, to give us a better view of what these moving averages can do. Now, there are generally like 4 types of moving averages. We have the simple moving average, which is called the SMA, the exponential moving average, which is called the EMA, the smoothed moving average, which is called, the smoothed moving average, just smoothed, and we have the linear moving average. I'll say that again. 4 types of moving averages: simple moving average called SMA, exponential moving average called EMA, the smoothed moving average, and the linear moving average. Just a minute. I'm sorry, I need to sort out something. All right, so let's continue. Someone is trying to mess up with this system. Don't worry, we'll have it under control. So we look at the types of moving averages. I think we stopped here: the simple moving average, the exponential moving average, the smoothed moving average, and the linear moving average. So what is simple moving average? A simple moving average, otherwise known as the SMA, is the simplest type of moving average. And basically, a simple moving average is calculated by adding up the last X period's closing prices and then dividing that number by X. And one turn off of simple moving average is that they are susceptible to spikes and can give false signal. So if you look through your charts, there's this tool called the simple moving average. It's very good, but like it is said here, that a simple turn off of this simple moving average is that they are susceptible to spikes and can give false signal. So that means that whenever there is a spike, they react to spike, and that can make them to give false signal. And also, it lags behind price. Now, generally, when we say that an indicator is lagging, what we mean is that the indicator moves after price has moved. It does not move real time with price. So it triggers you late into a signal or into a trade. That is what it means when we say that an indicator lags behind price. So a simple moving average lags behind price. And there is an example. We see on the chart above, we've plotted 3 different SMAs on the chart. And as you can see, the longer the SMA period is, the more it lags behind price. You can see that the 62 SMA is far away from the candles compared to the 30 SMA and the 15 SMA. Then we have the exponential moving average. And the exponential moving average is a type of moving average commonly used in technical analysis to analyze financial data, including stocks, stock prices, forex rates, and other trading instruments. The EMA places more weight on recent data points, making it more responsive to receive price changes compared to other types of moving averages, such as simple moving average. So the exponential moving average deals with more of recent data, unlike the simple moving average. This one deals more with recent data. So it is more smoothed and reacts better to price compared to the simple moving average. So let's look at the differences between the simple moving average. Now we're going to be focusing on the simple moving average and the exponential moving average, even though we mentioned 4 earlier, but these are the 2 that are most commonly used, the simple moving average and the exponential moving average. So we want to look at the differences between the simple moving average and the exponential moving average. So in terms of the weighting, the main difference between the simple moving average and the exponential moving average is how the weigh price data. SMA gives equal weight to all data points, while the EMA gives more weight to recent data, making it more sensitive to recent price changes. So this is an advantage that the EMA, that is the exponential moving average, has over the simple moving average. It gives you recent data. It deals more with the recent data compared to the simple moving average. And in terms of sensitivity, we say that due quickly to price changes, making it better for short-term traders. So if you're there, you are a short-term trader. Short-term traders do a lot of scalping and day trading. Then the EMA might just be what you need. Whereas if you are like a swing trader or a position trader, the simple moving average, which is the SMA, might just be the moving average you have to use. And in terms of lag, the SMA tends to lag behind price movement more than the EMA. EMA's responsiveness to recent data reduces this lag, but can up. So the SMA lags behind price more than the EMA. So this gives the EMA an advantage again over the SMA. And looking at choice, the choice between SMA and EMA depends on the trader's strategy and time horizon. Short-term traders might prefer EMA for its responsiveness, while longer-term trend followers might lean towards SMA for its smoother representation. And finally, in terms of crossover, both the SMA and the EMA crossovers are used as signals in trading strategies. The EMA crossovers tend to produce signals earlier due to its responsiveness, but false signals can occur more frequently. So in this little note I just read now, you can clearly see that how you use these moving averages depend largely on your trading strategy and the time frame on which you're trading. So if you're there, you are a day trader, you're a scalper, then the EMA is just the best moving average you can use if you want to use moving averages. And if you're there, you are a swing trader or position trader, then the simple moving average is just what you need to trade with. So let's move to the next slide. So next here, we want to look at how to use the moving average. And that is the essence of this class, how you can use these moving averages to profit from the market. Just give me a second. How do we use the moving average? So how do we use the moving average? Number one, we use the moving average for trend identification. You can use the moving average to determine the direction of price. So moving averages help traders determine the direction of a trend, upward trend, downward trend, or sideways by visually smoothing out the price data. When the price is consistently above When the price is consistently above the moving average, it may indicate an uptrend. And while prices below the moving average might indicate a downtrend. And here we can see an example. You can see that the candles, they are below, the prices are below the moving average, which indicates a downtrend. You can see that the trend is moving downwards. And in another instance, we could have seen a scenario where the price is above the moving average, which could indicate an uptrend. Now, the moving average also can be used to determine support and resistance levels. It can be used to determine support and resistance levels. So we say that moving averages can act as dynamic support and resistance levels. During an uptrend, the moving average might act as a support level where prices could bounce up, and in a downtrend, it may act as a resistance level. You can see here, the moving average here is acting as a resistance, and you can see price is trending downwards, resistance, price is trending downwards, and here it's acting as a support and price is bouncing up, support and price, is bouncing up. So you can use the moving average for this purpose, to identify resistance and support. And the next is that we can use the moving average to identify what is called crossovers. Now, a crossover is when you have moving averages or different time frames. Okay, moving averages or different time frames can be plotted on the same chart. And when a shorter term moving average crosses above a longer term moving average, it's often seen as a bullish signal, suggesting a potential upward trend. And conversely, when a shorter term moving average crosses below a longer term moving average, it's considered a bearish signal, indicating a potential downward trend. This is what we're saying. You can see here we have different types of moving averages. We have we have the one that is color blue, we have the red. You can see that at a crossover, you can see where the circle is right here. The blue, which is the shorter term moving average, cross above the red, and that gives an indication of a bullish trade. That's generating signals with moving average. Again, the blue, which is a shorter term trend, cross over the one which is the red, which is the longer term, and here it indicates an opportunity to sell. So when you have a moving average crossover, it's one of the powerful signal generating tools that is used in forex trading. Moving average crossover, where you have two moving averages of different periods. The one that has a shorter period, is called the fast moving average, and the one with the longer period is called the slow moving average. So when the fast moving average, in this case, is colored blue, when it crosses above the slow moving average, then we say it's time to take a buy trade. It's a buy signal. And when the fast moving average, which is the blue, crosses below the red, then we have a sell moving, a sell opportunity, a sell signal being generated at that instance. So how to use the moving average? You can use the moving average to generate signals. You can generate signals in by using the moving average. Just a minute. Some people are trying to join, so I'm trying to just respond to them. They're dropping comments in the comment section, or some of them are chatting me privately. So I'm trying to just forward the link to them. All right. So signal generation. Traders use moving average crossovers or the relationship between price and the moving average to generate buy or sell signal. For example, a trader might enter a long position when the price crosses above a moving average and exit when the price crosses below the moving average. We've already done that, shown you how it can be used to generate signals. So how do you set up the moving average on your chart? Now, when you enter your MetaTrader 4 desktop, this example is from the MetaTrader desktop version. You can see here, how do you access your moving average? You click on this area. This is the indicator button. You click on that indicator menu, then this drop-down menu will appear. You will see trend. Under trend, you scroll down to moving average. You click on it, and that is how you access moving average on your chart. Now, once you've accessed the moving average on your chart, the next thing you want to do is you want to go to how you can make use of it. Okay, then you go to this other panel here where you can now select. Here you are clicking on the moving average. When you click on the moving average, this panel here will appear where you now select the type of moving average. Remember, there are 4: simple moving average, exponential moving average, smoothed moving average, and the linear moving average. But then we said that in this course, we are focusing on the simple moving average and the exponential moving average. So in this example on the diagram here, we are selecting the exponential moving average. And once you have clicked on it, you now determine the period you want to use. So the period can vary depending on your trading strategy and even the time frame on which you are taking your trades. So let's look at moving average crossover once again. Now we say that moving average crossover, this is a common technical analysis technique used by traders to generate trading signals and identify potential changes in market trends. It involves comparing two different moving averages of a trading instrument price data to determine when they cross each other. This crossover can signal a potential change in the prevailing trend and is often used to inform trading decisions. So this moving average crossover is a very, very powerful trading strategy used by professional traders. It is used by professional traders, and all it involves is that you attach two moving averages. In this example, you have the 10 moving average and the 20 moving average. The 10 moving average is the one colored blue, and the 20 is the one colored red. Now, at the point here, now you now see that there is a crossover. The blue crossed below the red, and that gives a sell signal. It's that simple. When the blue crosses above the red, it gives a buy signal. That is as simple as you can use a moving average. Crossover, combine two moving averages together, different periods, one have a higher period than the other. Whenever the one that has the smaller period crosses above the one that has a higher period, it is an indication to buy. And when the one that has the smaller period crosses below the one that had the higher period, is an indication to sell, just like you are seeing on the screen as I speak. that's a powerful strategy there. Now we're looking at different strategies that you can make use of with the moving average. I tell you, that's why we call it, how to ride the trend, advanced moving average strategies. All we've done earlier is just to lay a foundation. This part we are entering now is a real meat, of this training, of this bootcamp training tonight, moving average strategy. I tell you, but at the end of this training, you will have picked a new strategy to use in trading the forex market independently. And the amazing thing about these strategies I'll show you is that you can actually do them on your phone. If you have a laptop, good, but then even if all what you have is just a phone, you can set this up on your phone and use it to trade. All right, so the first strategy I'll show you is how to combine the moving average with your trend line. Combining the moving average with the trend line. That is the first strategy we're going to look at. You can combine the moving average with your trend line to trade efficiently. How do you do that? You can add up multiple moving averages, at least minimum of 2, and you wait for a moving average crossover. In this diagram here, example, you are seeing a multiple moving averages were added up. The 5 moving average, the 10, the 20, the 50, 100, 200, about 6 of them. But the most important thing is that this moving average is giving us an idea of the trend. You can see at least the bigger moving averages are trending up, showing us that the market is in an uptrend. Then what next do we do? We draw a trend line that connects, lower highs together. And price broke out above the lower highs, and the moving average is also broke out above it. And you can see that a trade that generated 300 pips is what we can see on the screen from this simple strategy, combining moving average with a trend line breakout. So that is the number one strategy, we're showing you. Now, this strategy was done on GBP/JPY, on 4-hour time frame. Now, this instrument is actually very volatile. So, because it's not all currency pairs that can give you up to 300 pips like that. Even if they will give you, take a long time. But then GBP/JPY was able to do this faster because it's a very, very volatile pair. So here we have moving average being combined with the trend line to generate a trading signal as a strategy. So this is a bullish trade. We have another example of a bearish trade. Here you can see that with the help of the moving average, we can discover that the market is in an overall bearish direction. So we also draw another trend line, connecting the lower lows together in this instance, using the trend line tool to connect the lower lows. And you can see price breaking out below the trend line, and the moving average is crossing over downwards, the trend line break. And you can see that this generated 80 pips right in the market. So 2 instances of moving average with trend line. We can see the bullish trade and the bearish, the bullish signal and the bearish signal, which this has given us. Now, you can also use moving averages in combination with support and resistance. You can use it in combination with support and resistance. Now, in this instance, we have a moving average crossover happening at a support level. Now, price broke the support, and automatically the moving average also crossed below the support, generating a bearish signal. Moving average in combination with the support. Price broke the support and the moving average crossed below the support, generating a bearish signal. Again, here, now, if you are an advanced student, and that's why we've done quite a lot of things on trend line, support and resistance, candlestick pattern, chart pattern. We've done all those things. If you missed those lectures, you can go to our YouTube channel. That's a PU Prime Africa. Just go to YouTube and type PU Prime Africa. You'll see all our videos since we started this bootcamp, on different aspects of this training, from support and resistance, candlestick, chart patterns, and the likes. Everything is there. Now we want to combine the moving average with a candlestick pattern. And you can see the place that is highlighted blue. Now, the moving average, all it's doing here for us is giving us an overview of the general trend. The general trend here you can see is bullish. That's what the moving average is showing us. Now we can now see that within that bullish uptrend, we now can see a bullish engulfing pattern or a bullish engulfing candlestick pattern. And that indicates a further bullish movement in price, which generates 75 pips. And it's possible to still add, okay, this is the first one with bullish engulfing pattern. Now, again, we have an uptrend, moving average in combination with another, with is a candlestick pattern, bullish engulfing. The second one is another candlestick pattern, which is a hammer. From the training on candlestick, we learned that the hammer is formed when price is trending downwards, and you have the hammer candle being formed as a candle with a small body and long shadow, and the next candle to it must be a bullish candle. Now, the trend, the overall trend is a bullish trend from the moving average, and we have the hammer pattern being formed, and that led to a bullish 100 pips, on. So here we've been able to combine the moving average again with a candlestick pattern. And here we have the moving average in combination with a chart pattern this time around. Here you can see the moving average is in an uptrend. You can see all the moving averages are pointing upwards, and we now can see a double bottom pattern. We said the double bottom pattern looks like a W, and we have the neckline here. So price broke out above the moving average, above the neckline or the double bottom pattern, and you can see generated 75 pips up there. Combine the moving average again with another chart pattern, this time around a rising wedge pattern. Now we can see the moving average is in an overall bearish trend, and we can see now that we combined a rising wedge pattern. A rising wedge pattern is a pattern that reverses from uptrend to downtrend, in line with the overall bearish trend that we have on this currency pair. And this generated for us 500 pips on GBP card. GBP card is equally a very volatile currency pair. So here again, we match the moving average with a chart pattern to generate a trading signal. So how do you amplify with these moving averages? Number one is that you need to understand moving averages. Again, the simple moving average, the average of a currency pair's closing prices over a specific period, and the exponential moving average is similar to the SMA, but gives more weight to recent prices, making it more responsive to current market conditions. So you need to first of all understand the type of moving average you want to use. It's very important if you must use moving average to generate a trading signal. Number two is you need to select time frames. Choose a combination of shorter and longer time frames. For instance, you might use a 50-period EMI to identify the longer term trend and a 20-period EMA for the short-term trend. And that's why you see that the example I gave you, there were multiple moving averages. I told you that was 5 EMA, 10, 20, 50, 100, 200. So it's a combination of the shorter term moving average and the longer term moving average to give us a better view of the direction of the trend of the market. Then next is we need to identify the trend. Identify the trend. This is very, very important. We always say that in trading, the trend is always your friend. The trend is your friend until it bends. So you must identify the trend. So we say if the shorter term moving average is consistently above the longer term moving average, it indicates an uptrend. Let's quickly take a look at that again. If the short term moving average is consistently above the longer term moving average, it indicates an uptrend. Here, the red moving average up there is a 5 EMA, the blue is a 10 EMA, the light green is 20, the green is 50 moving average. You can see that the shorter term moving average is pointing upwards, and the longer term, they are all following suit. So giving us an insight into the overall trend here, which is a bullish trend. Number 4 is we now identify our entry point. Look for opportunities to enter a trade in the direction of the trend when the price retraces to touch or cross the shorter term moving average. This is often a sign that the trend is continuing after a brief pullback. So you can even decide to, get your own strategy aside the ones that we've shown you here. This is what we're saying. Here is an uptrend. Now, what we discovered here is a candlestick pattern, which is a bullish engulfing. But you can see that it still tallies with what we said right now. You enter when there is a retracement. A retracement is a temporary movement of price against the established trend. There was a retracement, a slight selling opportunity, but then we know that the longer term trend is bullish. So we'll wait for another bullish candle, this time around, which formed a rejection, which formed a bullish engulfing candlestick, which leads to a further breakout. If you check the other time also, you will see there was a retracement and a continuation, a retracement, a continuation, retracement, a continuation, retracement, continuation, and on like that. Here also, you can see a retracement and a continuation. So the moving average will always give you the overall trend. So your own job now is to look at when there's a retracement and a breakout, for you to trigger your trade in the direction of the moving average overall trend. Number 5, confirm with price action. Utilize other technical indicators or price patterns to confirm the trend's trend before entering a trade. Look for bullish or bearish candlestick patterns that align with the trend direction. So that's where our candlestick pattern, our chart patterns, that is where they all come in, our trend line. So we can use that as a confirmation, for us to enter into the trade. Number 6 is set stop loss. Place a stop loss order below the recent swing low for long positions or above the recent swing high for long positions and above the recent swing high for short positions. Now, I know some of us will have questions after now, but we can just quickly take or quickly attend to some of those concerns, because some will ask, how do we place a stop loss here? What we're saying is this. This is a recent swing low. Here we have a double bottom and we anticipated a bullish breakout. The lower part here is a recent swing low. So that's where your stop loss will be in a buy trade of this manner. And for the other ones where we add a bearish breakout, here will be the recent swing high. We anticipated a sell here. Up there is a recent swing high, and that will be the stop loss, for that kind of setup. Then set your take profit. Now we said that the take profit can be, you can use a risk reward ratio for that. You can use, if you're risking 20 pips as your stop loss, you want to make like 40 to 60 pips as your take profit. So you have a risk reward ratio of 1 to 2 or 1 to 3, as applicable to you. The number 8, risk management. Only risk a small percentage of your trading capital on each trade. That is, don't risk more than 1 to 2% of your trading capital on each trade. Use position sizing to adjust your trade size according to your stop loss distance and risk tolerance. Number 9, monitor and adjust. Regularly monitor your trades and adjust your stop loss and take profit levels as the trade, as the market progresses. I think this is self-explanatory. Don't just leave the trade to run. Always monitor. Move once you are in some measure of profit. Always move your stop loss to break even. and be prepared to exit the trade if the trend shows signs of reversing. Number 10, avoid choppy markets. Moving averages may not work effectively in markets with low volatility and frequent reversals. It's crucial to use this strategy in trending markets where the moving averages can help you stay aligned with the prevailing direction. So it's very clear here that it's to be used in trending markets, not in choppy market, not in consolidating market, not in ranging market. You either use it in an uptrend or use it in a downtrend when you are certain of a lot of volatility in the market. All right, that'll be all for tonight from the bootcamp. Tonight, we've looked at advanced moving average strategies, how to amplify your profits with moving averages. So we're going to take some questions now. You have questions on what we've done tonight. You can go ahead, you can type it in the comment section, or you can unmute your mic and ask your question now. The floor is open. The floor is open. You can ask questions. Yes, go ahead, Favor. Favor David, you can go ahead. You can unmute if you want to, or you can type it in the comment section. Okay. While we're waiting for Favor, another person. Another person. Okay, so while we're waiting for questions, don't forget Friday is our live NFP trading. You want to trade NFP, non-farm payroll, is the biggest news in forex trading. It's coming up live on Friday by 1:30 p.m. However, we're going to be online by 1:15 p.m. Now, to join that class, you need to have a funded account with PU Prime. It's only for funded clients. So if you don't have funds in your account now, you still have today, you have tomorrow. Make sure you fund your account so that I can be a part of that live session on Friday. We'll be trading live, we'll be making money live, and I don't want you to miss it. So plan to be in that class on Friday. And if you don't have an account with PU Prime, you can head over straight to our website at puprime.com, to open a live trading account. All right, I can see a lot of questions here. So let me just attend to the questions. Okay, Ogochukwu is asking, can you combine EMA and SMA? Well, I will advise you use them independently. Let me use that word. If you're using, we said that the EMAs are better suited for short-term trades, while the EMAs are better suited for short-term trades, while the SMAs are better suited for long-term trades. So if you are a day trader or a scalper, it will be advisable you use the EMA. And if you're a swing trader or a position trader, it's advisable you use the SMA. So if you're looking at that, it will be difficult to say you want to combine them, because it must be used in line with your trading strategy and the time frame that is suitable for you as a trader. So personally, I would not encourage combining the two of them together. But you can use multiple EMAs and multiple SMAs, in one strategy. As in, sorry, what I mean is that in a strategy, if your strategy is EMA based, you can use multiple EMAs in that strategy. And if your strategy is SMA based, you can also use multiple SMA. Use them independently, don't combine them together. Yes, all the courses taken so far are on YouTube, except for I think one or two that is undergoing editing. But almost all the courses we've taken in this bootcamp are on the YouTube channel, so you can always find them there. That's for Ifyok Unama. Farouk Oladipupo, the time frame is what can be set ahead of placing trade, right? No, the time frame is a you have it on your desktop, is what determines how long your trade will last, is what determines the kind of trader you are, whether you are a scalper or day trader, a swing trader, or a position trader. So it's on the time frame you can know whether your trade is a short-term trade or a long-term trade, whether it's a trade that will last for a few minutes or the one that will last for hours or the one that will last for days. That is a function of the time frame. So you need to determine the time frame that works for you as a person. And we've done this in one of the classes. That's why you need to watch the videos, that we've done so far in this bootcamp. There's one of the classes we handled, I think under the meta trader class, we talked about the time frame there. We devoted time to explain the time frame and how to apply it in trading. How can we use moving averages in different time frames? That's a beautiful question, Favor. How to use it in different time frame is that if you're looking at the moving average on a higher time frame, it can be used to determine direction, while the lower time frame can be used to determine entry. For example, if you have on the daily time frame, you have the 200 moving average. And the rule of the moving average is that when price is above the moving average, it indicates that you have an opportunity to buy. And if price is below the moving average, it indicates you have the opportunity to sell. So when you look at that on the daily time frame, you can look, okay, if the market is in an uptrend, that means you're looking for buying opportunity. You can now come down to a lower time frame and look for a moving average crossover. I'm trying to open my MT4 now so that I can show you what I'm trying to say. That's a very, very good question you're asking there, Favor. But while my MT4 is loading, let me answer another person. What does it mean, or what do you mean by volatility? Volatility talks about the level of activity, how price moves. For example, if you have a bottle of Fanta, or let me say a bottle of Sprite and a bottle of water, if you shake a bottle of water and you open the cover of that bottle, there's not going to be, nothing is going to happen. It will just be there. But if you do the same for a bottle of Sprite, you shake a bottle of Sprite and you release the cover of the bottle, the content will gush out. So we say that's how we talk about volatility. So the way that content rushes out shows that there's a lot of movement within that bottle because the pressure has been built within it. So it's what we call volatility in trading. And an instrument becomes profitable when it's volatile, because there's a volatility we're trading. If it's volatile and is going in the bullish direction, that is what makes us to take a buy trade and we make profit. If it's just on one spot and it's not moving, there's nothing to trade, there's no profit to make. But you can trade an instrument when it's volatile, either trending up or trending downwards. Okay, so I'm going to flip now to my MT4 to show this person that is asking about moving average on different time frames. That should be, let me see who the person is again. That's Favor David. All right, Favor, I'm flipping now to my MT4. Okay, now I'm on the MetaTrader platform. I believe you can see my screen. Now you can see here I have two moving averages, the red and the blue. The red is the 5 moving average. The blue is the 10 moving average. When the red crosses above the blue, it means we are looking for an opportunity to buy. When the red crosses below the blue, it means we are looking for an opportunity to sell. Now, your question is that what if you now have another moving average on a higher time frame? So this one here is on a 4-hour time frame. Okay, let me try to see the actual chart. Okay, let's go down to 1 hour. All right, this is what we have on 1 hour. Now, if we now want to have another moving average, let's add a 200 moving average. Now, to add the moving average, I'll come to this indicator section here, and I'll click on it. I'll go to trend, and I'll go to moving average. Now, I want to add 200. 200 is already there, exponential, and I leave it at close. Personally, I actually use more of exponential moving averages based on my own personal trading strategy. So I want to add a 200 moving average, and I want to make the color, let's make the color green. Now you can use any color. So feel free to use colors. It's not the colors that makes the money, you understand? Colors are just to help you identify the moving average and how you're using it. All right. So this is it. Now, the 200 moving average, which is a green, the rule is this. When the price is above the moving average, it indicates a buy. We have a crossover here. So generally, this whole region, price is in an uptrend. We are only looking for an opportunity to buy because that is what the 200 moving average is saying. So we now come over to the shorter time frame, the 1 hour, and look for an opportunity to buy. And here you can see that there's actually a moving average crossover here. Price eventually broke above even the 200 moving average, even on the 1 hour. But let's assume the 200 moving average is not on 1 hour. Let's restrict it to 2 hours, just like, to the daily time frame rather, just like you said. So I'm restricting the 200 moving average to just the daily. Good. So what this means is that on the 1 hour, whenever there's a crossover of the red and the blue, we take a buy. A crossover, we take a buy. Now, this one is a sell. Is it our trade? No, because on the bigger time frame, we are only looking for an opportunity to buy. You don't keep jumping at what you see. You only buy, you only take a trade in line with the overall trend. This is an opportunity to buy because that is generally on the bigger time frame, price is above the 200 moving average on the daily time frame. This is a buy. But at the same time, instead of you switching between time frames, that is another flexible thing with these moving averages. You can as well have that 200 moving average on the same time frame. You don't need to do much of a moving average crossover. I mean, you don't need to do much of a multi-time frame analysis sometimes with moving averages. You only need to have a bigger time frame. You only need to have a bigger moving average and a smaller moving average. Here you have the 200. This is the 200, which is the same green, and the 5 and 10. And here we have a crossover. The red cross above the blue, and all of them cross above the 200, and it's still a buy. You understand? So you can still add that 200 on the smaller time frame, and it will still be valid. Price is above the 200. There's a crossover here. It's still a buy. Again, now the only difference here is that here the red cross above the blue, but you cannot enter a trade until everything crosses above 200 here before you take a buy. So there will be some little delays here and there, but then on the overall, it's still, it will still give you good trades. So I hope that answered that person's question.
Hello, sir.
Hello, ma.
Good evening. Thank you very much for the training. I'm observing in this crossover, this example you gave us, there is a crossover where the whole chart is below the 200 MA and the 3 crossover just by the left side. And it didn't go far selling, but the buy went far buying. So how do we know when to? Yes, look at the left side. It crossed over below, but it didn't go fast selling.
Sorry, he said, let me get you.
Yeah, I mean, in this chart, we have a crossover down where the chart is below the 200 and the blue line is still below the whole chart, but it didn't go fast selling. The crossover at the left, the sell crossover, but the buy crossover went far. So how do we know that we should not sell at this left crossover when it was coming down? Hello, sir. Hello.
Hello, can you hear me?
Hello, I'm hearing you now.
Okay.
Wow, network. Not very clear. I'm not hearing you again. Oh, goodness me. Why now? Sorry, sir, I'm not hearing at all.
Hello, can you hear me now?
Okay, now I hear.
Okay, I said another thing you need to note about moving averages is that you need to combine them with other indicators. You don't use them as a standalone. As in, you don't use them as only strategy that you have, only indicator for a strategy. You have to combine them with other indicators to get a very good strategy.
Okay.
I hope you get it now.
Yeah, but which indicator will tell us? Because if I am on this trade now, immediately it crossover, all the crossover on this sell side, they all agree with what you said, but it didn't go far. So how will I know, or which indicator will tell me that this is not a good sell trade?
You can add an indicator like a stochastic. A stochastic will give you a better view, especially on a higher time frame. So if you add a stochastic on 4 hour, for example, I've attached a stochastic now. I want to take it to the 4 hour. I want to make it visible only on the 4 hour time frame. So now, I don't know if you joined one of our earlier classes where we looked at the MetaTrader platform. We looked at the stochastic indicator and we said that the stochastic, it helps us to identify overbought and oversold regions in the market. We said that when the market is buying, it buys to a level when it becomes overbought and will no longer buy, but rather reverse into selling. And when it's at an oversold level, it sells so low that it will not sell further. This is what I'm trying to say. For the stochastics, this region, the 80 is overbought, the 20 is oversold, meaning when stochastics gets to 80, instead of buying, it reverses to selling. Look here now, this is 80, and you can see price reverse to selling. This is another 80. There was a slight sell here. This is 80, and you can see price declined. And at the 20, price looks for an opportunity to buy. This is a slight buying on 20. This is another buying on the 20. And if you look further, there are times when all of them may not, be too perfect, but that's why you just have to look at different instruments at different points in time to get a clearer picture of what is happening in the market. This is a 20, and you can see the market is buying here. This is another 20, and you can see the market is buying. So you need to first of all look at a higher time frame to know what the market is doing. Then you can now make your entry on a lower time frame. So if I wanted to take a buy now, I will have looked first at a stochastics at 20, because when the stochastics is oversold, that is when I know the market will reverse into buying. So if I cited the stochastics at 20 here, then I can now go to a lower time frame, which is like 1 hour. Like I said, you use the higher time frame to know the trend and the lower time frame to know the entry. So I can flip now to the lower time frame, which is the 1 hour, and I can now apply the rules of the moving average. So I can now say, okay, I want the price for a buy. I want the price to be above the 200 moving average, and I want the 5 moving average to cross above the 10. Here now, the 5 cross above the 10. Here, everything cross above the 200, and you can see there was a massive bullish opportunity. So this region you are talking about that it was a sell, it didn't go for long, is because there is no sell there at that time. It's a buy that is a main trend because the stochastics, was oversold at around 20 before the reversal happened. I hope that answers your question, man.
Yes, sir. Thank you very much.
You're welcome. All right, so we're rounding up now. Let me attend to the remaining questions. I've attended the question on volatility. Emmanuel Eber, good evening, sir. Please, how do we calculate our position size to fit our risk tolerance? Well, for that, I can refer you to babypips.com. Just go to Google and type position sizing calculator. Now you see a position sizing calculator from Baby Pips. It's an online calculator where you put in your risk limit and that is your the percentage of risk on your account, your trading capital, and the stop loss, and it will tell you the lot size you're expected to use. But then if you don't even know how to do all that, the simple rule you can use is this. If you're trading with any account less than $300, don't exceed 0.01 lots. You see, the lot size amplifies your profit, but it can also amplify your risk. So, and if you keep it minimal, your profit will be minimal, but your risk will also be minimal. You are not expected to make all your profit on one single trade. You are supposed to compound your profit on multiple trades. So that you are using a 0.01 lot is not too small. You see, if you want to use a bigger lot size, then you need to have a bigger account. So that's why I say any account less than $300, don't go beyond 0.01 lots. If you have any account like $1,000, you can use 0.02 or 0.03. Don't use a standard lot or $1,000 account. You will blow that account. It's a question of time. If you want to trade with a standard lot size, you need minimum of $10,000 in your account to do that. So even if you don't know how to do your position sizing, if you can limit your lot size, you'll be safe. You will limit your risk if you can limit your lot size. So I hope that's answered Emmanuel Abel. If you're Kunama, can we use 0.02 lot size to trade during the NFP on Friday for those with account size of $100? If you open two trades, this is what I would advise. If the signal given is TP1, TP2, then I would advise maybe you should just start with 0.01. Just learn how this thing works. 0.01 in two places is 0.0. You can earn like maybe some $5, $7. That would be like $12, which is good money. $10 in Nigeria now is good money. $10 is over 15,000 naira. You understand? So just use 0.01 in two places. If you have a $100 account, you will still be safe with that. Oluwatobi, the chart seems to show double bottom too. You're an advanced student. That's good. Yes, we can see there's a double bottom on that chart. But what we're doing here, we're doing more of the moving average thing. It's good you can cite the double bottom. It gives you additional information about what the chart is saying. Okay, I think that's the last question I have here. Or does anybody still have a question? Because I'm rounding up now. So don't forget, this bootcamp continues on Friday by 7 p.m. Let's join, a little earlier on Friday. And also on Sunday, we still have the bootcamp on Sunday. The bootcamp will end on the 15th of September. That is roughly a week and some days from now. And I believe by the end of this bootcamp, we will have become a better trader, being confident to take trades by yourself by the level of the value we've been able to give during the course of this training session.
So I used to get the link very late. I don't know where you dropped the link. All I will see is join the boot camp without the link.
Okay, we'll look into that.
I joined very late today because I had to DM you. And before the link came, it was over 20 minutes.
Wow. Okay, we'll look into that, but that's not the same for most other people. We have multiple groups, so I think that there was just a slight glitch in that. Others got it a little earlier than that. So some got it, like an hour or less than an hour before we started. But we just let me just know the group you belong to, so that we can really know what happened in that area. We apologize for that. So on Friday, don't forget NFP by 1:30 p.m., but we'll go live by 1:15. The link will be dropped around 1 p.m. Please make sure you are live on the platform so they can get the link to join us by 1:15 p.m. Sir, is there any physical class? Yes, we have physical classes on Tuesdays and Thursdays, and that is still operational. So tomorrow there'll be physical class in Abuja and Lagos. So if you live around Abuja and its environment, you can get to our office tomorrow at Work and Connect building, 50 Ebitu Ukiwe Street, Jabi, Abuja, for physical training tomorrow. And if you live around Lagos and its environment, you can join us at Agos Business Suite at 54B Adeni Jones Avenue, Ikeja, Lagos. All right, that will be all for tonight. Take care and have a wonderful night rest. Don't forget, this video is going to be uploaded on our YouTube channel. So you can always go to that YouTube channel to watch. And I would also encourage you to subscribe to that channel so that whenever we drop videos, you will be notified and you can watch and learn how to trade Forex. Take care and bye-bye, and have a wonderful night rest.
Thank you, sir.
You're welcome.